Welcome back to the Entry Level Trading course by Valetax. My name is Ryan Ferrier, your educator for this course. This is episode 10. On this episode, we're going to be discussing why most beginners lose. And this is psychology basics for trading. As much as trading is very much technical and fundamental, we cannot take away the psychological part of trading because at the end of the day, trading is an avenue to capital growth, which means that for as long as finances are involved, emotions would always be a part of it and would be on the high side. Trading doesn't only shape you as a trader, but it shapes your whole perspective about finances and also helps you deal with your emotions to get better. Because at the end of the day, profits or capital growth isn't based off emotions, it's based off structure. And that is why we need to discuss about psychology for you as a beginner, so you have an idea of what you're getting yourself into ahead of time. So keep following. Trading is a mental game. Okay. The real battle is between you and yourself. You see, it's same chart, but different results. Emotions affect your decisions and psychology determines your execution. When you have emotions on the high, your decisions could get cloudy because this time around, you either could probably be trading from a place of lack or urgency. When you're trading from a place of urgency, your emotions are high. You're trying to get results immediately. And this can further cloud your judgment to try to make quick decisions and start to think that trading is a get rich quick scheme. Whereas that's not really the case. It's about being patient, having control over your emotions, and having a stable psychology that would determine the type of executions you make, what your stop losses would be, and what your risk targets could actually turn out to look like. Now, there are a couple of emotions that we need to talk about when it comes to the psychology of trading. And most importantly is fear. Why fear? Fear is responsible for one of the most popular things in the market, which is the fear of missing out and the fear of loss. So the fear of loss is, because you're scared that you do not want to take a loss, you are in some profits and then you'd run out of the trade. So you never actually let a winning trade happen. You don't let winning trades run. You're very quick to leave the market, or probably you're in a drawdown and you're nowhere close to your stop loss yet, but you end up closing the trade in loss. So you find out that you're not making as much profits and you're always closing your trade in loss because you're scared of losing overall. Now, the fear of missing out is basically caused by two things: early exits or late entries. The fear of missing out is seeing an opportunity that you never had the opportunity to get into at the appropriate time. So now you're scared of missing out. So you either jump into the trade too early or you jump into the trade too late. And this happens a lot of times when you've made technical analysis and we're thinking that, oh, if I wait and I don't enter this trade, I will be paying. So we end up entering the trade too early and we suffer losses. Or the trade has moved ahead of us already and now we're trying to chase it. So we get late into the trade, and that would result to us having wider stop losses and put our account on a more porous risk exposure. The next emotion to think about is greed. Greed is one of the second most overruling emotion in the market. This is where people start to double down on their risk positions. They're over leveraging their account. They are trying to overtrade. Even after they've made losses or they've hit the threshold for the amount of trades they are supposed to take. So probably they've made a lot of profits and now they're feeling invincible. So they start to say things like, just one more trade. Or probably they've made a lot of losses and they're trying to recover. So now what they want to do is, because they've lost, some part of their capital, now they want to get that capital back. So they keep telling themselves, just one trade. And then they end up making even more losses and ruining their account. Another one is moving their take profit. You've set the take profit goal, but because you think the market would continue to climb above, and now you want to make more money, so you keep adjusting your take profit goal. And prices eventually doesn't get to your adjusted take profit and reverses on you and end up making a loss on that account. These are, counter effects of greed when it comes to your trading. The next thing we want to look at is overpatience and overtrading. You can see that every other thing relating to psychology in the market can be based off these two emotions, fear and greed. Impatience sometimes comes from greed and fear, while overtrading sometimes comes from greed and fear. So overtrading can be in the scenario of where you are trying to meet up to a certain target. That's greed. You're trying to make more money. That's greed. Whereas it can also be fear. You've lost some money. Now you're trying to make it back. So you're scared of losing money that you're overtrading just to try and cover up the losses you've made. Impatience, on the other hand, could also be as a result of greed. You were not just patient enough to take what you had and move along, but rather you wanted to trade to make more. That's impatience because you want to make everything in one day instead of understanding it's a long game, it's compounding. So that's impatience. Or you've seen a trade and you're rushing too early. So that's a fear of missing out. So you see that a lot of the psychology falls based off these two emotions of fear and greed. So trading without confirmation and trading out of boredom. One is out of fear, the other is out of greed and overconfidence too as well. How do we fix this? The first thing you need to do to fix this is awareness, and hence why I've put this in the beginner course for you to understand. You need to be aware that the market is highly psychological and is filled with a lot of emotions. So coming into this venture, you need to come in prepared to be the best version of yourself, to work on yourself, to be more disciplined, and to also manage your emotions too. This is the journey you're signing up for, and you have to be prepared for it. You can't fix what you don't notice. That's why it's important that when you start learning, you start to journal and take notes of everything you learn and everything you notice, your emotions and how you felt when you started trading. Emotional control starts with self-observation. You need to observe yourself, which is the first key of every trader. Observation. What did you do wrong the first time and what could you have done better? The next thing is discipline beats intelligence. No matter how intelligent you think you are, if you're not disciplined enough, you're going to consistently make losses in the market. That is why even pro traders also sometimes make mistakes and they make losses in the market, not because they're not intelligent, but they just fell short of their discipline. And it happens to the best of traders. And you need to understand that losses are part of the game. These mistakes are also part of the game. But at the end of the day, it is your ability to observe yourself and see where the mistakes are coming from. And that brings us to the end of this episode. I hope with these few words, you've been able to understand how trading is really a psychological game. Technical analysis is important. Fundamentals are important. Building a sentiment and a bias is important. But overall, what makes you profitable or makes you stay losing is the psychology and the emotions you let flow through your trading. So keep that in check and work on it as you start your trading journey. And in a couple of months, you would be unrecognizable.